bring in Robert Sinche, head of FX strategy for the Royal Bank of Scotland. Thank you so much for coming down from Stamford.
It's great to be here.
It's the ultimate sacrifice to have, even on a Columbus Day. Was it slower because it was Columbus Day?
No, the Express was good.
It was good. Okay, good. There's just so much to talk about. You were at the Greenspan event last week. We had the IMF go through, and yet currency wars is like green shoots. It's the phrase that keeps on giving. Is it a war? Is it a battle?
Well, I think it's certainly a disagreement. I don't know if we'd call it a war yet. Hopefully it doesn't get to war stage. Certainly, I think if markets really thought there was a currency war going on, I doubt we'd see that VIX slipping below 20 today.
And so that's that cross-asset analysis we want here, looking at the equity market, and you use that right into the foreign exchange market. Let's look at dreaded first chart over here, Bob, since you've got this chart tattooed to your brain. Real trade-weighted dollar, price-adjusted trade-weighted dollar. Do you just assume dollar weakness below that 2008 and 1995 lows?
Well, there's certainly a potential for that to unfold over the period ahead. A lot will depend on how aggressive the Fed is and how things are going in the rest of the world. But certainly the dollar is at a very competitive level, and certainly not an impediment for U.S. exports, not encouraging U.S. imports. Not clear how much more the dollar can really do in terms of stimulating the economy.
Is this about a weak dollar, or is it about stronger euro, stronger Korean won, stronger Brazilian real?
Well, you've got two different parts of the world there. I think with respect to, if you look at that chart with respect to developed currencies, we are very close to the lows, record lows. If you look at
this is important when you take out the major countries.
Right. When you look at it versus emerging market currencies, and the Treasury calls these the OITP, other important trading partner currencies, there the dollar's only about 7% below its average in real terms since the introduction of floating exchange rates back in 1975. So that's where the adjustment process needs to continue. That's what the disagreement is at the G20 this past weekend. And that's really the battle going on between China and the U.S.
Matthew, go back over here and show us this chart again. Over on the left side of the chart, that spike, that is the Plaza Accord. And you could see how we come down the mountain there in the late 1980s, 87. You and I have spoken of the Louvre Accord. That's the one nobody ever talks about. Provide a distinction between the famous Plaza Accord and the less-known Louvre Accord.
Well, the Plaza Accord is really about reversing dollar strength in the early 1980s. I used to have a friend who referred to the dollar strength in the early 80s as the 4 R's, Ronald Reagan and real rates, and those certainly were the big upside pressures on the dollar. The Plaza Accord was an attempt to reverse that and bring the dollar lower. And as you noted, it came down very sharply during that period. The Louvre Accord was basically to say, okay, we've done enough. It's now time to stabilize the dollar. And that took place, and it actually did have some impacts on the dollar.
Let's look at the other side of the story. Asia is watching, and I brought this up, Bob Sinche, because this is dollar renminbi. This is back to the first adjustment in 2005, and you can see the managed curve there. Then we flatline. Are we going to see a mirrored managed curve? Are we going to see 06, 08 yuan appreciation from here?
Well, that would be about another 20% over the next few years. And I think the Chinese would be willing to do that if the global economy were growing rapidly. Remember, this is a period, 2006, 7, and 8, when the global economy was growing in a very robust fashion. China was able to appreciate its exchange rate, yet maintain very strong export growth and very strong growth in their domestic economy. That's where I think the Chinese are a little bit more concerned. And instead, they've decided, I think, to take a little bit of a different approach. You can revalue the effective exchange rate in two ways. One, you can let the exchange rate get stronger. Second, you can let your domestic wages and prices go up, particularly domestic wages go up. And that will make your currency appear as though it's stronger and be less competitive on world markets. Now, the reason I think the Chinese want to go that route is there's pressure on them to increase domestic demand. How do you increase domestic demand? You increase real wages, and they'll spend it and they'll consume it at the same time that they're trying to introduce some of the safety net measures on retirement income and unemployment insurance, et cetera. So I think the Chinese feel as though they're taking a very good policy path. We've heard about big wage increases in China earlier this year. That will stimulate domestic demand, make them less competitive. The only problem is a very gradual process, certainly one that's not going to have any impact between now and November 2nd.